Hello and welcome to Oil Market Insight. We're here today at the OPEC headquarters on the occasion of the 177th meeting of the OPEC conference. And joining me on our panel of experts, Halima Croft. Halima is the Managing Director and Global Head of Commodity Strategy for RBC Capital Markets. Halima, thank you so much for being with us. We're also joined by Alicia Lukash. Alicia, the Senior US Shale Analyst with Rystad Energy. Great to have you aboard. And Jason Schenker. Jason, of course, is the President of Prestige Economics. Now, Jason, let me just start with you, if I can, and really have a look at perhaps what's going to be impacting, what is always impacting the market. But number one, the state of the global economy. I think let's get an overview in terms of how things are looking out there, what we need to be concerned about, what we need to be watching, and bring us up to date.
Well, I think the first thing is that we saw a really big slowing of growth in 2019. Looking into 2020, global growth is likely to remain choppy. We're going into the year as the Eurozone's in a manufacturing recession. The U.S. is coming off of a business investment recession, and Chinese manufacturing is only modestly growing. These things are going to be challenges for the year ahead. That's important to watch. Against that, though, is the reaccommodation of monetary policy. So the Fed and other central banks have taken steps to cut rates or expand, or in the Fed's case, re-expand their balance sheets. And these sorts of moves are going to be positive for growth in the year ahead. They're also likely to be supportive of asset valuations and the price of things like crude oil.
And of course, these are all elements that have to be watched day by day, week by week, month by month. Talk to me about when we look at growth in demand, Jason, in particular when we look at US, looking at the economy there, despite some of the worries perhaps earlier in the year, people talking about throwing out the R word, it didn't quite happen. But talk to us about the state of the US economy right now. And of course, we're looking ahead to a year where we're going to see elections. And how are things playing out? How comfortable do you feel sitting in Texas right now?
Yeah, so there's two things. I mean, when we think about recession, most people, because of saliency bias, they tend to think of the Great Recession. And what they don't realize is that we had a manufacturing recession. There was a business investment recession in the United States in late 2015 and early 2016. And yet the whole economy remained buoyant. Why? Because 70% of the economy is driven by consumption. And right now, the labor market's even stronger than it was in 2015, 2016. We did have and have had a, right now, ongoing business investment and manufacturing recession in the U.S. again. Does that threaten the overall economy? Not as much, because 70% is driven by consumption. Job market is great, lowest unemployment rate in 50 years. Wages are up. Those things are positive for the overall economy, still remaining positive, even though we see GDP growth slowing. Where this year we were expecting 2 to 2.5, we've been consistently expecting next year would be 1 to 1.5. We still see that kind of range. Front half of the year could be weaker, back half could be stronger because the monetary policy takes a while to kick in. Against that backdrop, though, on a global basis, the other place to look is China, because that's one of the biggest sources of additional marginal demand for crude oil. China is the biggest net importer in the world of crude oil right now. All the OPEC forecasts really underscore how important China is for demand, and the U.S.-China trade war could continue on. It has, as we've seen, even recent legislation has been passed in the U.S. supporting Hong Kong against China. This shows that some of the challenges in the relationship between the U.S. and China might not be very quick to thaw. And what that means is that we could see this kind of conflict maybe continue on. If that happens, it'll be a challenge for Chinese growth. But as we've already heard, some of the manufacturing and supply chains will maybe go and spread around, disperse to other economies. But global demand growth still likely to be 3% or so in the year ahead. It's just maybe where the additional demand comes from, and the additional oil demand might not be as China-centric as we've been previously forecasting.
And again, when we look at the year, we see the Chinese trade talks, I think, is almost like 5 steps forward, 3 back. Everybody wants to see some resolution. It's not happening as quick. Jason, when you look at, OPEC and OPEC Plus, and it viewed to, I suppose, from international eyes, do you think OPEC is doing as much as it can do at the moment? Has it done everything it needs to do out there to make sure that there's stability in the market?
Oh, yeah, I think so, especially if we consider the fact that we've had a Chinese manufacturing recession, a Eurozone manufacturing manufacturing, a U.S. manufacturing recession in the last year, and oil prices still are where they are. Because the same thing happened. China went into a manufacturing recession at the end of 2014 that lasted until the middle of 2016. And we all remember what happened to oil prices during that time period where they really hit that bottom in the early part of 2016. We haven't seen that in oil prices this time around because the group has had much tighter control over the production despite a big shale boom. So I think that shows it's been effective. We didn't see a massive collapse. Look at what happened to aluminum prices in the last 2 years, or copper, or a number of other industrial metals. Those markets, just the bottom completely fell out. They have absolutely tanked. And yet we didn't see that happen with oil, and that's because OPEC's got its hand firmly on the rudder.
And again, I think we look at this around the world and we look at it in terms of efficiencies that everybody brought in. Now, Jason, we have to look also at the environmental concerns, but I think also, the fact that oil and gas is still needed and investment is very much needed. So it's sort of a tough parallel path in many ways that people have to navigate.
Yeah, you've got these two huge bifurcated dynamics. On the one hand, you've got the fact that 30 years from now, the global population will include 2.1 billion more people than it has now, and that 30 years from now, real per capita GDP in China and India will be triple the level it is now. The fact that you see people's wealth rising and population growing makes it very difficult to actually expect to see significant CO2 abatement or reductions in the future. But that doesn't mean, to Halima's point, that we're not going to see this. We are going to see it. We saw almost 40% of activist investor initiatives in 2018 were tied to climate change, sustainability, or something else environmental. And we're going to see that. We've seen record all-time highs of overall activist investor activities and initiatives in 2018, both in the U.S. and globally. We're going to see new records of that going forward. We're going to see probably even a rising percentage focused on environmental and sustainability and climate change sort of issues. But it's very difficult for companies to imagine in this boardroom, I'm going to affect climate change. They can think about how they're going to be more energy efficient, or they might reduce their footprint of CO2 or the like, but to actually impact climate change at the board level, that's a very difficult thing to actually do, especially as we see a rising global population with rising wealth. So these are really big challenges because energy is a fundamental ingredient of economic growth and wealth, and the economy does not grow without it.
And I think this is something that, I think the industry probably is a message it needs to maybe spread probably clear in 2020. Jason, I'm leaving you the closing word here as we round off Oil Market Insights at the end of 2019. What do we need to be looking at for the year ahead?
So for 2020, I'd like everyone to kind of think about the headline and the trend line. And the headline is going to be focused very much on the central bank policy that's going to be accommodative, and the economic data that indicates whether manufacturing is doing well or not, like the global purchasing manager indices out of the US or Europe, or the Caixin manufacturing PMI out of China. Focusing on those headlines is going to be really important, as is to a certain extent what happens with the trade war and the back and forth. But I'd also almost carry that over to part of the trend line, that the potential conflict between the U.S. and China over economic, military, political hegemony could continue and accelerate in the years beyond. So that's a trend to consider. That's going to add volatility. But I'd also say there's a reason OPEC is in Vienna. Even during the Cold War, when the Soviet Union and the U.S. were at loggerheads, oil still moved around because the global economy still needed it. The other couple of points I'd point out are the demographics, long-term trend, people getting wealthier, more people on planet Earth, they're going to need energy. And even though there are substitutions, liquid hydrocarbons are the most efficient form of energy for transportation purposes, full stop. And the last piece I point to for technology, that we're going to see companies work hard to automate, to do robotic process automation in the back office, anything they can to reduce costs, to bring those drilling costs, lifting costs down, to cut their way to profitability so that oil can still flow. And e-commerce. We see that's rising right now in the U.S. It's still below 11%. We're going to see that continue to rise in the U.S. and globally significantly in 2020 and the years ahead. And that means more miles driven. And that means more hydrocarbon demand. So those are the big thoughts I'd leave.
Well, so the dynamics are, it's very fluid, and even as Halima says, it's about being very nimble to make sure that you can actually handle all of that. We have to wrap it up here. We could talk for hours on this, but I really want to thank you all for being here with me and for your great insight and sharing that with us. Halima, thank you so much. Elisa, and of course, Jason, thank you so much. And thank you for being with us here. This has been the Oil Market Insight on the occasion of the 177th meeting of the OPEC conference here in Vienna. So stay tuned, of course, to the OPEC website, www.opec.org.